Hey guys, James here with Waterford Business Solutions, and today we are going to continue our discussion on corporate tax returns or business tax returns. Today we're going to start pulling a little bit out of the corporations and talk more on partnerships. Now, when we talk about partnerships, there's a lot of things going on here. So today's video is specifically going to talk about Form 1065. Now, when we go into all of this, there's a lot of things that I need to make sure y'all understand because there's a lot of different types of partnerships legally, even though they're all considered the same for tax code and tax reasons. And then partnerships, even though they file this form, have the opportunity to make elections on other forms. So we are going to start out with the easy big elephant in the room that I'm honestly here to answer is how do we handle taxes on Form 1065? Then I'm going to go into what are the different options that a partnership could use to change how they file their taxes from a Form 1065 to a different form. And then finally, legally, what all classifies as a partnership. So we're going to be in kind of three different sections today to understand everything. But we're going to start with how is a 1065, how is a partnership handled? Well, a partnership or a Form 1065, it's a pass-through entity. Just kind of like our 1120S, our S-Corp, any funds that are reported on that Form 1065, the partnership or the LLC, because an LLC also files a Form 1065, they will go ahead and pass through to the members or to the partners. The corporation or the business won't pay anything there. So that's the first big thing is partnerships and LLCs are always pass-through entities as long as they file a 1065. Ultimately, the 1065 will produce a K-1, which the partners or members will claim on their personal returns, and that is where the taxes will be paid. Overall, though, the benefit to a partnership is how things are handled, how monetarily things are handled. If you remember last week when we were talking about corporations, we talked about how putting money into a corporation, you won't see gain given circumstances. However, with a partnership or an LLC, you can always put in property. You can always put in any type of ownership, whether it be physical property, intellectual property, like houses, land, or materials and equipment. You can put all of that into the partnership, into the LLC, without having to recognize any gains, which is highly unusual to see that happen. So that is a huge benefit. Whereas with a corporation, there's sometimes that there's a benefit, there's sometimes that it's not. It's a hit or miss there. So that is a huge thing there. But that's also a huge reason why most corporations and S corporations, we don't see property, real estate go into that. But we will see a lot more of that happen in a partnership, which is all great. However, at the same time, if you take property out, obviously putting property in is great, but if you take property out, with the corporation, you will see a gain. No matter what situation, you will see a gain on that property that you're taking out. Whereas with a partnership or an LLC, it generally does not trigger a gain. Almost 99% of the time, as long as it isn't cash, it will not trigger a gain, which is great. It saves you money. It provides you with a better savings, a better way to move things around. And that is why partnerships are so popular tax-wise. Because of the fact they are a pass-through entity, we don't have double taxation like we do with a corporation, and the fact that we can put property in and take it out without seeing any type of increases there. Now again, it is so important to remember with that pass-through entity that means you are, as a partner, as a member, if it's an LLC, going to have a K1, and that's going to be where the income is recognized as on your personal returns on your 1040, which we will talk about later on. Very important to keep in mind there. Now, as I said at the beginning, partnerships and LLCs, they can make an election to choose something else. And we already talked about one of these election forms. Any partnership, any LLC can elect to be taxed as an S corporation with Form 2553. That way, you are taxed as an S corporation and you get the benefits of that S corporation tax. If you want to understand what those benefits are, go back and watch our S corporation video, or go to our page for S corporations, which I will tag below, on our website. It will be very beneficial to watch that, and we also have a video there that explains what Form 2553 is. But partnerships and LLCs can also choose to be taxed as a corporation by filling out Form 8832. So you can either be an S corp or corporation and be taxed as those entities, even though legally you are recognized as a partnership or an LLC. So you have the ability to do that. Definitely go if you're interested in understanding the benefits or the detriments of those types of forms and how it goes through. Visit our S Corp page or our 1120 page, our regular corporation page, to understand what those forms are. But any partnership LLC can elect to do that. Now, we get into the fun legal stuff. Partnerships is going to be anything that is unincorporated. So it's not a corporation. You haven't filed articles of incorporation. Fairly straightforward there. But then we have multiple different types of partnerships. I'm going to start with probably the simplest one, where it might be a husband-wife situation. Husband and wife go ahead and get into business together, and we don't have they both partner together, agree to be together. That is going to be fairly common, fairly simple, being quite honest there. They can elect to be a qualified joint business. That will not activate as a partnership. A qualified joint business does not activate as a partnership. That is still going to be filed on your 1040 as a Schedule C, not with a 1065. Then we get into our other types of partnerships. Just a regular partnership, which is where multiple people get together, at least two. You have to have at least two people for a partnership. Otherwise, it's just a sole proprietor or a single member LLC, which we'll talk a little bit more about that in a little bit. But at least two people get together to agree to run a business. Basically, not just spend money, but also make money. So you can't just get with your neighbor and agree to spend money and have a partnership. You have to actually have a business venture in mind. You don't have to legally have any paperwork here. You just have to have an agreement. Now, that paperwork statement really does depend on your state. Please keep that in mind. But in general, partnerships don't require articles of incorporation, notifying the state, anything like that, depending on your state. So that's just a regular partnership. Legally, both partners have no liability protection. All of their personal assets are at risk, not just financially with the business, but if the business was to be sued. Then you move into a limited partnership. A limited partnership is where one partner has full risk, another one has limited risk based on just their investment in the company. That is all that is at risk there, which is perfectly fine. That's great. Then we have limited liability partnerships and limited liability limited partnerships. Those both reduce some of the liability, but nowhere near as much as a limited liability company. So it's highly unusual that we see an LLP, a limited liability partnership, or a different LLP, LLLP, 3Ls, limited liability limited partnership, because by the time we're getting there, most people are considering a limited liability company, which fully protects any members. You're no longer a partner in an LLC, you are a member. It fully protects all of their assets. As long as you have more than 2 people in this LLC, you would file a Form 1065 with your partnership or with your LLC. If you can be a sole proprietor, a single member LLC, you can still incorporate into an LLC, and an LLC is a legal entity, which means you do have to file paperwork there to do it, but you can go ahead and still be one person, a one-man show LLC, which would be considered a single member LLC. That will not result in you filing a 1065. That would still be a Schedule C on your 1040. So definitely keep that in mind. Most partnerships, as long as it is not a qualified joint business or a single member LLC, will file a 1065. Those other two, a qualified joint business or a single member LLC, will file a Schedule C on their 1040. The other thing that you have is if you elect to be taxed as an S Corp or as a C Corp on an 1120S or an 1120, you would not file a 1065. So all very important things to remember there. Stick around with us and we're going to continue this series and keep on trucking along here, guys.